I'm your host, Peter Reznicek from ShadowTrader.net, and this, of course, is the weekend edition. In today's video, I'm going to talk about my call from last week saying that the market had topped, which obviously it didn't, which had me short SPY to the tune of a loss of about $8,000 last week. And also some put verticals that we had on with my subscribers in my weekly options room, but those fared a lot better with a much, much smaller loss. And I'm going to go over that in detail in today's show in a segment called Option School to talk about how we were actually long debit on the put side, and we did a really cool adjustment to it and then ended up getting out relatively close to break even, kind of unscathed. So that should be exciting, especially for newer traders that are just starting to dip their toe into the options world. We're obviously also going to go over the charts in detail. If you thought it was overextended last week, it's obviously more overextended this week because the only pullback we got was that FOMC move. I'm also going to show you a couple of really cool things going on in market profile as well. All right, all that and more in today's weekend edition. All right, time now for looking ahead, where we take a brief tour through the 11 sectors that make up the S&P and the major averages, and a few financial instruments that I deem to be important, some of which I trade all the time, like Bitcoin and gold. As always, these percentage changes are measured from Monday's open to Friday's close. That's all I'm interested in is what was the tradable activity in the last week's period that we just finished. And of course, everything up on the major average side, as you can see. Russell was the clear winner, which is not surprising because it was a week where the Fed lowered interest rates, and obviously the majority of the companies in the Russell are actually not even profitable, and so a lot of them are indebted, and of course lower rates is better for them. NASDAQ was strong as well, up about 1.85, almost 2%, and the S&P also tacked on almost 1%. Very, very much mixed bag as far as the sectors are concerned, and I want you to pay close attention to everything that I'm talking about right here, because this is sort of a look under the hood in and of itself, meaning that this is almost like a market internal. Remember that all of this, if you will, the sectors here, all of this translates very, very directly into this. All of this makes up this, and it's all weighted where the technology contributes the most and the financials contribute the second most, and the healthcare and the consumer discretionary, et cetera, on down. This is not in the exact correct order of weights because things have jumbled. It changes every single month. Consumer discretionary is actually the third highest sector, followed by communications, and healthcare is actually lower. So I actually need to jumble this a little bit to make it more accurate, but you get the picture. And what I'm getting to is the fact that you don't really have any robust advances over the course of the week except for here. And this has kind of been the tail of the tape for some time, where the market just goes how technology goes because it is 33.5% of the market. And it's almost like as long as tech is strong, it doesn't matter so much. But I've always said that I don't think that that's sustainable, that you need a broad-based advance to constantly keep going to the upside. At the very least, you need to be passing the baton. And this happens a lot in bull markets where you will see that a sector will be strong one week, weak the next, but that weakness goes into another sector. But this week was relatively weak, I thought, across the board with, what is this, 5, 6, 7? 7 out of the 11 were actually down at the end of the week. Some of them down a good bit, like real estate, materials, healthcare, consumer discretionary, energy, consumer staples down quite a bit. So it was really just all about tech this week and financials. And somewhat in industrials and communications. So a lot of that stuff that's, towards the front end there was very, very strong, but everything else not so much. So, just look at it as like a market internal. Things are not firing on all cylinders. There's some sectors that were very strong this week and many of them not. Outside of that, bonds had kind of a poor week. They actually went down a bit. The 10-year yield actually increased, which is interesting, much to people's chagrin, because I'm sure they thought that at the end of the week we'd be somewhat lower there with bond prices higher. Remember that mortgage rates in America key off the 10-year. This is it right here. It's all about this 10-year. Volatility increased a little bit. Gold tacked on another 1%. The covered call play that I've been doing on the gold options, on the futures options on futures, I should say, still continues to work really, really well. In addition to the longer term play in the Z contract, which I haven't touched. I'm just sort of leaving that alone and trying to add to it, but I'm not getting any opportunity. There's just been very little pullback in gold to try to add to the longer term position. Crude oil was down 1%, and Bitcoin didn't have the greatest week, down about 1.19%. All right, let's talk about the charts now. Let's move into what's really going on and get deeper into the technical picture of the S&P 500 and the NASDAQ 100. Okay, let's get into the charts where the rubber meets the road. I call it what's really going on because, of course, it is what's really going on as opposed to what everybody else wants you to think in terms of opinion or bias or news or whatever. What really is all that matters is what did price action do over the course of the week. So we generally look at the S&P and the NASDAQ 100, which is the two most important indices in my mind, also the ones that I trade most often and use as my barometers for the broad market. So starting with the S&P daily here, yesterday, or I should say last week, excuse me, in last week's show, we were right here. This was it before these 5 sessions. And if you recall, I was talking about potential for a pullback because we had traveled up from this low and we had also come right up against the edge of the channel. And after that, on Monday, Tuesday, we actually stayed even more outside of the channel. We did not come down at all. And on the Fed move, we came down to here, rallied back up, and now we're here. And so I think the main takeaway for this week is that you have been outside of the channel now for 4 sessions, which to me is somewhat unsustainable. I talked a little bit last week about the overextension from the 8-period exponential moving average, excuse me, and it's about the same. We were about 70 points, I think, last week, and now we're about 60 points. You can see that the close today was 6664, and our 8 EMA is at 6601. So you're 63 points above, which is a little bit high. So what's going to happen now? Obviously, I don't know that any better than anybody, but the next round number, which is right in here, you don't see it there very clearly, but the next round number is at 67, which may actually be in play. The 66 was what I was referencing last week, saying, okay, there's potential here in addition to all the other data points that I laid out as far as why this could be a top, and yet we're 60 points higher. So does that mean that the 67 may be something? Maybe. I mean, that's not something I would really hang my hat on. All my analysis last week, if you recall, was really more focused on the channel high and the overextension from the 8, etc., and the fact that we were coming to the Fed. And part of my overall thesis was that the small 25 basis point cut that we received a couple of days ago was already baked into the market. Well, apparently not. Now the market is fixated on the fact that there should be 2 more cuts before the end of the year. I believe Powell didn't really confirm or deny that, but I think the more important part is that he didn't flat out deny that. So the market obviously construes this as quite dovish and wants to power higher. So I would say since you're in an all-time high area where there is no resistance, watch for that 6,700 and see what happens at that 6,700. There's potential that you get a turn there. If we were to go there straight up from here, meaning on Monday or early Tuesday, that really would extend you quite a bit from the 8 EMA. Obviously, this 8 EMA is going to catch up a little bit, however much it'll move up in a day. But you're going to be, instead of 60 points overextended, you're going to be more like 70 to 80 or 90 points overextended from that 8. So I'd be very, very careful if I was a new long at this point. Before I get off this S&P, just switching it to a weekly real quick. I've talked about this before, that this is just really, really steep without a pause. When it was really steep like this for a couple weeks straight back here in June, you can see that you got a pause. This was a good amount of downside activity with one large corrective week, and now you're doing it again where you're just getting very, very steep. So again, could the market go higher? Absolutely. I'm not fighting it here. I don't have anything short on, but it is probably not good location for new longs. And remember, trading is much like real estate, honestly. Location, location, location. It is literally the most important thing. If you have proper trade location, everything else will work itself out more or less. Okay, let's move over to the NASDAQ 100. I'm going to go back to the daily here. And similar situation where you're a little bit overextended here from its own 8. I talked about the channel in the other, and we obviously need to talk about the channel here. So that would be this high to this high. And you can see that there's still plenty of room if you want to look at it as the top of the channel here as far as the NDX is concerned. So it doesn't have that working against it, I would say. But again, same relatively kind of steepness. And if you look at the weekly, just kind of straight up, right? So same thing. I would say not really the best trade location for long either in the NDX. Let's take a quick look at the market profile while we're at it, especially important when we are at all-time highs to see what's going on. So a lot of nuance happening here that is basically right under classic market profile theory. So much classic things going on here that really you can use market profile to make sense of. Have to remind everybody, I write a newsletter about this every single morning. If what I tell you is going to resonate with you, which I believe it will, I give you a full dose of this market profile stuff every single morning before the market opens in my Peter's Pre-Market Perspective report. There is a link in the description below. Look at the overnight high made here in right there, and then the regular trading hour session high of the 18th fails it. But the market profile theory tells us that these overnight highs are almost never secure. Auctions do not end. I'm saying if the overnight high is the high of a move, if it's the all-time high, if you just have an overnight high that's like higher than other sessions inside of a range, it doesn't mean anything. But in this case, you carry that forward to say, you know what, this is probably not the end of the move. Lo and behold, Friday, what happens? Much higher, and you notch a new high in an RTH session. RTH stands for regular trading hours as opposed to the overnight session. Now, in this Friday session that just closed today, one thing I want to point out is it is a double distribution. And a double distribution means that it's got single prints here separating the two distributions. So what's going to happen Monday is you're going to treat this like two separate days. This is, you can think of this as 1 and 2. And wherever we trade on Monday, that's a little bit more bullish or bearish depending on where we trade. We did notch a pretty legit excess high. It's also a spike high, to be honest with you. The spike is when you make a new high in the last period of the day. This is actually the penultimate period. There is the O period after that, but the O period is the one that I mark from 4 p.m. to 4:15, so it's a shorter period. So the end period is the final period of the day, and when you make a move up like that on single prints in that N or O period, we call that a spike, and that puts spike rules into play. And spike rules basically are that we're going to watch for Monday to see where we open in relation to the spike, basically. So if this is the spike, then opening inside of the spike is very bullish because it confirms those high prices that were only there for a short period. This is, of course, the most bullish outcome before, and opening below the spike is less bullish because it basically denies these prices. Remember that prices that print without corresponding value are not prices where the market will remain for long. Basically, you can think of it that way. The market is going to continually move away from those prices and into areas of value where the market was more comfortable having two-sided trade and more futures contracts were being distributed. So regardless of that, we do have an excess high in, and so that is a legit high. That is potential, I should say. I like to use the word potential to be a secure high, as opposed to, for instance, what I said, you know, if we were having this conversation back here, looking at this high, I would say, no, this is not a secure high. There's potential that the market actually goes higher because this isn't the way it's supposed to end. It's not supposed to end in an overnight session. And lo and behold, it did not. All right. Going into next week, actually, before we go into next week, but really it's the same level that I want you to look at. You're going to have basically one key downside reference into next week, which is definitely going to be today's low. And I say that specifically because it is the top of a single print section where there was a lot of emotion. In the Thursday session early on, you had a lot of emotion pushing hard and in that area and leaving that skinny part there, which is a single prints. And here's what's noteworthy. I want to leave you on this note is the fact that this was also very, very classic market profile theory. It couldn't get any more classic than this, was that this happened in the middle of the morning today, an F period. The profile starts with B, so every 30 minutes it's like B, C, D, E, F. So you're actually in the fifth period of the day, the fifth, 30-minute period of the day, and you go down. And you can see the volume tapers a little bit, but it's not that strong of a taper. Usually this volume would taper more coming in. You'd have more 3 digits. But regardless, the theory worked perfectly in that. And I talked about this in the pre-market perspective before this day even started at 9 a.m., saying that the main downside reference has to be this single print section, not not the low of the 18th, not the prior day's low, but this very nuanced section that nobody, and I mean nobody who's looking at candlestick charts is even going to know that this exists. They don't. How are they going to know it exists? It's inside of the bar. All you know, if you chart that way, is just O, H, L, and C, and maybe some indicators and some studies on top of it. But as far as the price action, that's all you know. That's all the candlesticks are going to give you because it's very two-dimensional. But in the profile, we know that inside of that bar of Thursday, inside of it is this very, very key level of 6687.75. And look what happened on Friday today. You literally went 2 ticks into it. That's called rejection, classic rejection, as opposed to acceptance. Acceptance is when you move into an area, breaking a low or a high or some key area, and you have 2 TPO periods, meaning the letter periods that you see printing going sideways. 2 of them have to print back to back in order to have acceptance. Here you only have 1, but more importantly, you only have 2 ticks. So it was really like the market was telling us that it came into the single prints, but it had no interest in repairing the single prints down here. And this is especially noteworthy because understand that where an area is like this, where there's no volume, or I should say no value is what I meant to say. There's no value. There's just this single print area where the market spent very little time and it was very emotional. Those areas should be areas of lack of support when the market comes down into it. So this is a classic WWSHD play on Friday, which stands for when what should happen doesn't, because if the market comes into here, it should move lower because this area here is like no support, all this. That's like a void. That's almost like a gap. So think of it almost like a gap, and you come 2 ticks into the gap and turn around and boom, you go. And you can see he actually had quite a strong close on Friday. So I just wanted to point that out. Obviously, it's in the rearview mirror. I totally understand that. But this is a level that I talked about pre-market, saying that this was the key downside reference. And most people, you know, if you're not using market profile charts, they would probably tell you that the key downside reference has to be the prior day's low. I mean, what else would it be? But that's not what it was. It was really this area right in the middle. And it did turn out to be a very important turning point in Friday's trade. So a little bit of market profile nuance for you there. All right, that is all. Okay, class is in session. Time now for options school. Hopefully this will be illuminating to a degree. But before we get into that, I'll talk about what my trade was on the S&P, which I had just shares short. So if I show you here, 4,000, and you can see here I shorted them at 659, give or take a couple pennies here, and bought back here at 660.63 soon after the Fed for a loss of about $1.60 on the 4,000. That was just over $6,000 loss. And if you recall in the introduction to the program, I said it was an $8,000 loss. The reason for that is because I also put on a hedge of 40 contracts, which cost me a couple grand. Because obviously 40 contracts equals the same as 4,000 SPY. So I needed 40 contracts to hedge, where I was short puts and also long some calls. And by the end of the day on the Fed, the hedge just basically went out worthless. And I found myself still short the shares, which is kind of unfortunate because the market actually closed like right about at my entry, just a little bit higher. And then if you recall, after the Fed, the market the futures rather, just started creeping higher. And at 6:30 p.m. Eastern on that evening, I actually closed this short on my phone because I just knew it was going to turn into something ugly. And it was a very good thing that I did because, as you know, we went much higher on Thursday and Friday. As I was also saying in the introduction, there was also an options component to this, which was the official play that I did with my subscribers in the weekly options room. And that was a SPY put vertical, which only lost about $89, I believe, on 2 contracts, which wasn't bad. So in order to show you that trade, I'm just going to pull up the weekly options room track record, which I've been keeping for many years. Green highlights mean trades that are open. Everything else is closed. You can see it's marked with a close. And the trade in question is obviously the SPY, which is right here in the middle of the page. And as you can see, I said that it lost $89. So let's break this down for a little bit. So the first thing that happened was 2 directional put verticals were entered, and they weren't cheap. They were $10 wide because I felt the move would be big. So obviously when the anticipation of a larger move is there, you don't want to be buying a cheap vertical for 40 cents that's like $2 wide in the SPY or whatever. You got to go at least 10 assuming that the S&P is going to back off at least 100 points. So it was put vertical for the end of this week, purposely using the September 19th expiry, as you can see here. And that cost 317 for the first one. And then the market bounced a little bit and the next day. And I still felt that the market hadn't really negated my thesis, so to speak. So on the 12th of September, I actually bought another one, which was a little bit cheaper. So we were into this trade for about almost $600 right here. You can see between these two put verticals, okay? Then what happened next was that we started coming into the FOMC day. You can see the dates here of the entries here, which would be 9/17 on the FOMC day. And what happened then was I purposely sold another put vertical here that was actually inside of the spread. And what that does is it forms what's known as a condor. And a lot of people hear this word condor and they automatically think iron condor, but these are actually two separate trades. And those of you who know me know that I absolutely hate the iron condor. I think the iron condor is a completely stupid trade. You're making a bet on the market not moving, and if the market isn't moving when you at the time that you make the bet, then that means that volatility is probably somewhat compressed. So you're basically, I don't know, you're selling cheap volatility in the hopes that it doesn't rise, basically. And you're also making a bet on that the market itself or some financial instrument won't move, but the nature of the market is to move. So I'm not a fan of the iron condor, but this is a condor, which means that it's opened up on one side of the chain. Iron in options terminology always means both sides of the chain, right? Iron condor means you've got something going on the put side and on the call side. But when it's a condor, it's just on one side. And in this case, it's all on the put side. So what exactly did I do here? If you look at the strikes very closely, you can see that what actually happened was the original vertical was a 658, 648. And we're going to look at the options chain in a second so you can see this more clearly. And then for two contracts. And then what you can see is that I sold inside of that by doing a 650, 640, right? The spread is 658, 648, but somewhere inside of that, I put on a short vertical into the long that was 650, 640, and that creates a condor because the condor structure moving down on the put side is like this, right? And here it was -1, +1, and you can see it's inside basically. And this here can be anywhere. It can be under here for a condor, it can be inside. Any of this makes it a condor where you have long put vertical and short put vertical. If the short was here at the exact strike, then of course that would make a butterfly, right? Because this would be a 1-2-1 structure. But when it's inside or below, it is a condor. And the reason that I did that was because I knew I needed to bring in as much premium as I could at that point because the trade had already started to go a little bit south. And I said, okay, just in case we don't move on the Fed, we don't move down at all, I'm going to do this trade here and see if we can bring in some premium to knock down this big debit. And you can see here that it does. It brings in a good amount. $200 knocks it down by about 33%. It's basically about a third. And what it did was it left me with this particular structure here, which was the condor, which was the 658, 650, 648, 640 put condor. And to make a very long story short, that was looking good only at the low of the day on Wednesday. But obviously the trade was weakness going out to September 19th. So I didn't think it made sense just to close it just then to make a small gain or whatever. It wasn't trading for that much of a gain. As you know, the move down wasn't all that big. And it turned around very quickly late in the afternoon and closed basically very, very strong. So what I did basically on the 17th, which was the same day as the XP, you'll note that I knew that my cost all in, once I totted this up, my cost all in was about $1.95 anyway, when I took all these, and you can see that I took the opportunity to close half of the position at $1.95. And there's a method behind that madness, because when you are in what I call a debit situation, where you have paid for something, and the market your position is not profitable, the first thing you have to do is start figuring out what that position costs you net. So in this case, I have my debits for my long verticals and I subtract what I sold in the short verticals. And I knew that I came to a cost of like $1.90 or somewhere around there. And so if I believe that the trade has potential to go south, but still has some potential to go in our favor, I close half. And knowing that I could get break-even prices at that $1.95 at the end of Wednesday, I took the opportunity. And one of the reasons also I should mention is why I didn't close the whole thing at break-even is because it doesn't usually make sense to do that at the end of a Fed day. At the end of a Fed day, it's very, very common that whatever happened on the Fed gets retraced, and you get this negation of what happened on the Fed. It's like a one-day move, and then the next day is opposite. This didn't happen because at the end of the Fed move, we closed very strong, and then we continued to go up from there. So I took the opportunity to take one, and as you can see, the next day, which was here on 9/18, which would have been Thursday, very, very close to the open, just seeing how we were trading. I said, you know what, it's time to just bail. And luckily we were able to get still just over $1 for that last, or I should say second half of the trade, which is the other put condor, and net, we closed the trade for about 89 bucks loss. So not bad being dead wrong on direction. And had we not sold those put verticals inside of the condor to sort of ease that cost a little bit, it would have been worse. But even more importantly, what it would have been really bad is if we were trading this as if it was a binary outcome and waiting for that expiry to occur. And that's just not the way to do it. So if you can take away anything from this little options school that I'm telling you right here, it's a couple of things. One is whenever you have a debit spread, vertical especially works generally with vertical. If it's already a complex spread, there's still things you can do, but let's just talk about the vertical. Consider turning the vertical into a butterfly, meaning selling another vertical of equal width with the short strikes being the same. Or if you need more premium, put something up into the spread. And I could have actually gone much, much higher. You'll notice in this example, I sold the 650, 640, which would have still given me $8 of potential profit in the SPY had the market fallen. And I did that purposely because I wanted to bring in credit, but I also wanted to leave potential for profit because I still thought the market could fall. If your conviction is lower than that, you can always take that put vertical that you have, and this is the one you're going to sell, and move it up real tight. So instead of selling it outright, you could put that short right underneath, meaning that this piece here was 658, 648, correct? If I wanted to get most of the premium out, I could have went 657, 647. And instead of bringing in $1.02 per contract, it would have been much higher. But again, I had some conviction that I thought we had potential to go a little bit lower, right? So there's that. And then the other thing I can't stress enough, if I could just end on this note, is be nimble. Remember this. This date right here, which is your options expiry date in your trade, meaning whatever series you are trading in, see this date right here, September 19th? That's your expiry. It is meaningless. Meaningless. Get that out of your head. Okay, most options traders make the mistake that they are not fluid with their options trading. They don't move and flow with the market. They look at it as like placing something here and then letting it expire on the expiry or taking it off on the day of expiry. I don't look at options that way. I never had. To me, it's very fluid. It is an instrument to buy and sell daily, depending on what the market is doing. And so to that end, I would just say to you, just be nimble. If you find yourself being wrong, your gut is just telling you this is not working, bail out immediately or put on some type of an adjustment that gets back 70, 80, 90% of your debit at least if you want to maintain that trade, all right? So that's my option school segment. And I will just say in closing that leaving this page up, it is quite noteworthy that there are only 2 trades that are highlighted in green. All right, this is noteworthy just because that kind of tells you how I feel about the market. Obviously, I'm trading mostly 99% from the long side in this type of market, but it's a little bit overextended. So this tells you a lot. And notice the nature of the trades. One is Bitcoin. It's IBIT. And I just started this one. This one's actually small. It's going to get bigger. We did the same trade in Bitcoin that expired today, actually, and that one worked out quite well. You can see we had an IBIT trade on that expired here on the 19th, and that was a good one. And we're going to basically just do the same trade over, which I call a risk reversal, which is basically that we are short puts in IBIT, and we're using that money to buy call verticals. And this should be bigger. Hopefully, we'll get up to about either 2 or even as many as 4 call verticals, and we can sell as many as 8 here. on the put side. And also, we are using a staggered expiry in that we're pushing our call vertical out to October, to the first week of October, to that expiry, and we're using the closer in time expiries to sell the put premium so that that put premium can roll off, and hopefully we can do it twice, which is actually what we did in the trade that closed earlier in the week. If you'll notice, there were different expiries here. You can see how the series was September 9th, September 19th, and the 12th. There was two different series of puts, and that actually allowed us to get the call verticals on for better than free. We actually traded at a net credit. So these call verticals that had a max value of 3, we had no problem closing them for about an average of 2, because that 2 was pure gravy to us. Basically, we had already paid for them and their cost was 0. So it's a good feeling to be able to knock down that debit all the way to 0 and then some, using some put sales on the other side. But again, the main takeaway here from what I'm doing officially in my room is that we're pretty quiet right now. Bitcoin is somewhat correlated with the market, but not really anymore, less than it used to be. And then we've got this one trade here on Tesla, which is a directional trade to the upside, but it is a call ratio. And if you look at these strikes, 435, 460, they're pretty rich in premium. And even if this completely falls apart, I have no doubt that we'll be able to get back that $2 debit if need be. As always, we wrap up this weekend edition with a little thing we call looking ahead. Just take a quick look at what's going on with economic data and earnings. We're not in an earnings season right now. Obviously, we're going to start another one in October when the Q3 numbers start to come in a few weeks. But for now, there's just a few names, a couple of scragglers, if you will, that are just kind of just starting to come in. Those would be AutoZone and Micron. Cintas could be interesting. Those are the uniform people. And that's kind of a bellwether, I think, for the economy, how they're doing. They provide uniforms for all sorts of blue-collar workers and service workers, et cetera, things like that, which is interesting. Accenture in the consulting space, and also Costco. And Costco is definitely important because that's one of the biggest retailers in America. So I always think that their earnings report is definitely of note. All right, beyond that, existing home sales on Tuesday. Monday is very quiet. So expect that actually is more bullish than bearish, I always like to say, for the market. If there's no news, the market likes that, and it's potential for it to go higher. New home sales on Wednesday, initial claims on Thursday. We always get that employment data every single Thursday. And Friday is going to be PCE, which is pretty big, and also personal income and personal spending. All right, so that kind of rounds out the week of September 22nd to 26th. Nothing really happening on the economic front until Tuesday, and then it ramps up a little bit. And again, just a smattering of earnings still coming in at the tail end of the last season before we start again for Q3 in later October. And that's all for this week. Thank you, as always, for spending a little bit of your weekend with me. Remember, if you can, please hit the like and subscribe buttons and also the little bell icon to be notified whenever Shadow Trader posts new content, which is every day through our Shadow Shorts program. You can sign up for those free videos on our homepage at shadowtrader.net. So just to recap a little bit of what we talked about, we continue to be overextended here, a little bit overextended from the 8 EMA, and just on kind of the outside of that channel if you connect those highs in the S&P, but that does not mean that we can't move higher. Part of me feels like this market is entering into kind of a blow-off top phase where the euphoria just gets even more parabolic. There's certainly potential for that. I am just not looking at it too heavily here outside of what I'm doing in Bitcoin and gold. I'm really not that interested in new longs here until I see a little bit of a pullback, maybe catch up to that 8 EMA. I just think that the location is not that great here. But the market just, keeps chugging higher every single day. There does not appear to be any sellers. And to that end, I will leave you on this note is, if you can, do your best to learn a little bit about market profile and learn about nuance, and most importantly, learn about signposts, especially those of you that have been smacked hard by trying to short this market over and over and it's not working because maybe you don't have the discipline to get out quickly and change your mind right away when it's necessary and kill off those losing trades as fast as possible. I mean, just in my example of the SPY short of those few thousand shares, think about how bad it would have been had I held on past late Wednesday afternoon, right? By Wednesday evening, a couple hours after the RTH close, I was out of there and the market went so much higher on Thursday and Friday. So be nimble. And if you can, polish up your options trading game, which I'd be glad to help you with. I'm doing it every single day in my room. The link is in the description below, shadowtrader.net/options. Come join me there. We can trade together, and I promise you I can take your options game up to the next level, all right? On behalf of myself and the entire Shadow Trader team, I'm recording here in beautiful Los Angeles, California. As always, I'm wishing you good trading and good night.